If you felt like completely overwhelmed by the financial news this week, I just want to say you were not imagining things.
Oh, absolutely not. It was a lot.
Right. It was just this chaotic, almost random flood of massive global events just hitting the tape one after another, moving so fast it felt like standing in front of a turbine.
Yeah, I mean, my initial read coming into Monday was just the standard consensus framing. I was looking at the schedule thinking, okay, it's just a naturally busy week.
March Madness for the markets.
Exactly, just March Madness. We had central bank meetings, tech keynotes, inflation data. It all just felt like this big coincidental scheduling pileup.
But what if I told you that chaos wasn't an accident?
Well, that's what really surprised me when we started pulling the primary sources.
Because what if the calendar itself is functionally designed to act as policy,
Yeah.
keeping you reacting so quickly that you completely lose sight of the bigger picture? Welcome to Gilded News. This is episode 19, the week the calendar took over.
It is such a fascinating way to look at it.
We're taking a reflective Friday zoom out today, diving deep into a really interesting stack of public documents, schedules, and economic data from Monday through Thursday.
And our mission here is to cut through all that consensus noise I was just talking about.
Exactly. We're going to synthesize this massive flood of events and establish a clear, actionable dashboard for you to use next week. Because when you strip away the punditry, there's a very clear structural choreography that emerges from the chaos.
Yeah, and the focus today isn't just about, what happened. It's about precisely when it was scheduled to happen.
Right, the timeline.
We are going to explore how the calendar basically became the engine driving the narrative. And then we'll equip you with the exact forward-looking metrics to watch next week so you can stay, several steps ahead of that engineered consensus.
So here is our roadmap for the show. First, we'll unpack the hidden pattern of this week's data flood. We'll look at how the economic plumbing and AI regulation actually share an identical blueprint.
Which totally caught me off guard, by the way.
It's wild. And then we're going to pivot hard to the future and break down the specific liquidity tests happening next week. So let's start with this idea of a naturally busy week. You argued at first it was just a coincidence.
Right. I mean, everyone was saying it. But when you map the timeline, you realize the schedule is the narrative.
It's a structural weaponization of time.
It really is. Let's walk through the sequence logically. Monday kicked off with the GTC conference.
Right, the big tech keynote.
And the immediate media takeaway was all about, the next generation of semiconductor chips. Just pure hardware hype.
But structurally, if you look at the framing, it wasn't just a software iteration. They framed AI as a massive infrastructure and energy issue.
Yes. You aren't just buying processing power anymore. You are negotiating for power grid access and sovereign level data centers.
Which obviously sets the table for heavy, sustained capital expenditure, and that requires massive debt issuance down the line.
Exactly that. And then, almost as if on cue, Tuesday kicks off this central bank super week.
Oh, the timing is impeccable.
Right. If you look at the Federal Reserve FOMC meeting calendar, which is at federalreserve.gov monetary policy calendars.htm, you see this incredibly tight window of global monetary decisions.
You had the Bank of Japan, the Fed, and the Bank of England.
All making generational policy pivots within 48 hours of each other.
Wow.
And stacking multiple central banks into a window that tight, it acts as a real-time stress test on global liquidity.
Because it forces the market to process competing liquidity regimes all at the exact same time.
Exactly. It reveals which systems are leading the charge and which are just reacting to the dominant player.
It's a synchronized global policy maneuver. And right in the middle of this deep, below-the-surface balance sheet plumbing, Thursday hits us.
Yeah, Thursday was the shocker for me.
We get a historically hot upstream inflation print via the Bureau of Labor Statistics.
Right.
The raw data is at bls.govnews.release.ppi.nr0.htm. So you've got AI infrastructure demands, global central bank pivots, and wholesale inflation spiking.
All colliding in a 4-day window.
And that collision is where the mechanism of control lives, right? Because the calendar itself acts as policy.
Yeah, I totally see that now. When the schedule is intentionally packed to the brim, every single event is framed by the media as the next big thing.
It creates this manufactured sense of inevitability.
Right. It actively prevents the public and, honestly, even institutional investors from sitting with the implications of any single piece of data.
Because if the BLS PPI data prints hot, you don't have the mental bandwidth to digest what that means for upstream manufacturing costs.
No, you can't. because you are instantly forced to pivot to a central bank press conference an hour later.
It's like being on a fast-moving conveyor belt in a factory.
Oh, that's a good analogy.
When the items come at you this fast, you only have time to react to the thing right in front of your face.
Yeah.
You grab the inflation print, then you grab the AI news, then you grab the Fed rate decision, and you completely lose sight of the entire factory floor.
And you lose sight of who's actually operating the machinery.
Exactly. That blind spot is the goal.
So, to reclaim your agency, your actionable intelligence for next week is to build what we call an anti-calendar.
I love the anti-calendar concept.
Yeah, you just pick one primary source that matters to your thesis and treat it as your absolute ground truth.
So if you care about rates, you bookmark that FOMC schedule page and literally ignore the rest.
Right. And if you care about inflation, you set your browser to the BLS release page.
You check those primary documents before you read a single word of punditry.
Yeah.
You have to dictate your own sequence of information.
Because if you don't, the calendar keeps you distracted with the what instead of the how.
Which brings us to our second segment. Because if we use your anti-calendar strategy and actually sit with the raw data, something bizarre happens.
It really does. I was so surprised when this started taking shape.
You start seeing identical blueprints in places that shouldn't be related. Like I was looking at the inflation plumbing data next to the AI regulatory news.
Two totally different worlds, supposedly.
Structurally, they are essentially the exact same story. How do inflation mechanisms and AI permissions end up with the same architectural shape?
I know, it sounds totally absurd on the surface. But when you step back, you realize both domains are currently operating on this ladder structure.
The ladder structure.
Yeah, there are systems designed to funnel power and capital upward through very specific choke points.
Okay, let's break down the mechanics of those choke points. Let's start with the price ladder. We just talked about the BLS PPI data, but how does that connect to the broader system?
So pair that upstream inflation data with a recent Bank for International Settlement speech on cross-border payments.
Okay.
You can read the whole speech at bits.org, EDULNASO 260360d.htm. When you synthesize these two documents, you realize inflation isn't just a single monolithic number.
It's not just the CPI headline you see on CNBC.
Exactly. It is literally a ladder. It starts at the bottom rung with upstream wholesale costs.
The raw materials, the PPI.
Right. And then it moves up through a buffer layer.
And that buffer layer consists of corporate margins, supply chain frictions, and specifically the plumbing of cross-border payments you mentioned.
Yeah, the friction in moving money internationally acts as a hidden tax.
A massive hidden tax,
Yeah.
right? Every time capital crosses a jurisdictional border, the correspondent banking system extracts a fee.
A huge fee. And that friction is the middle rung of the ladder,
So the cost is stepping up layer by layer.
compounding at every choke point. Until finally, after all those costs and fees compound, it reaches the top rung.
The final consumer toll, what you and I actually pay.
Exactly. Now, what blew my mind is when you map that exact same architecture onto the technology sector.
The permission ladder in AI.
Yes, specifically regarding the recently withdrawn Commerce Department AI chip export rule.
That was a phenomenal development that got completely buried by the central bank noise this week.
Completely buried. But if you pull up the official Office of Information and Regulatory Affairs filing page, which is at reginfo.gov, publicduo-details.r 1292166.
And there's a great Reuters context report on this too. At Reuters.com, Business-Commerce Department withdraws planned rule 8-chip exports government website 2026-0313.
Right. If you look at those, you see a massive shift in strategy. The government basically withdrew the planned rule on physical AI chip exports.
Because controlling the physical hardware is like playing whack-a-mole.
Exactly.
If you try to block the bottom rung of the ladder, the silicon itself smugglers will just route it through third-party countries. It's totally inefficient.
That is the exact realization they had. So AI is moving up its own ladder. It started at the bottom rung with the hardware.
So it's like the raw materials and inflation.
Right. And now regulatory bodies are moving to the middle rung, export permits and software authorizations.
Because they are realizing that you don't need to control the physical chip if you control the software stack that makes the chip useful.
Precisely. And ultimately, it is climbing toward the top rung, which is sovereign AI packaging.
It is no longer about who has the fastest processing unit.
No, it is about the overarching authorization environment. Who gets to build the massive data centers and on what sovereign terms?
But wait, let's look at why nobody is talking about this connection.
It's media siloing.
Exactly. Tech reporters cover semiconductor supply chains and API access.
And macroeconomists cover CPI, wholesale inflation, and correspondent banking.
These beats are completely isolated from each other in the media ecosystem. You never see the hardware reporter sitting down with the cross-border payments economist to compare notes.
And that media compartmentalization is the ultimate shield. Because reporters are forced to stay in their silos, the audience fails to see the overarching architecture.
They don't realize that both of these systems, inflationary plumbing and AI regulation, are ultimately about the exact same thing.
Who has the structural power to extract the toll at the very top of the ladder?
The ultimate toll collector.
Exactly.
Whether it's the bank taking a cut of the cross-border payment or the sovereign state dictating who gets to run an AI data center.
Because these two seemingly disparate systems share the exact same shape, you can bypass all the segmented media noise by applying the same mental model to both.
So your actionable intelligence here is simple. Next week, when you see a major headline, pause and ask yourself, where am I on the ladder?
Such a powerful question.
If it is an inflation story, ask, is this a pipeline cost at the bottom or is this the final consumer toll at the top?
And if it's an AI story, ask, is this about the physical hardware or is this about the ultimate regulatory permission?
By identifying which rung you are looking at, you instantly strip away the noise and see where the actual leverage is in the system.
Where am I on the ladder? That
Yeah.
completely reorients how you process the daily feed.
It really does.
Yeah.
So let's take that framework and apply it to next week, segment 3, the first clean read.
Okay, let's look ahead.
We are drowning in CPI and PPI data right now. Wall Street seems obsessed with these hard inflation prints.
They are.
But my issue as a systems thinker is that this data, as impactful as it is fundamentally backward-looking.
Very true. It tells us what already happened last month.
Right. So if we want to know where the economy is actually going, what is the first fresh catalyst we need to watch?
You have to look at the S&P Global March Flash PMI data.
The Purchasing Managers Index?
Exactly. It arrives next week on Tuesday, March 24th.
Okay.
S&P Global actually published a crucial research note outlining this. You can find it at spglobal.com/on Market Intelligence News Insights Research 2026-03 Global Economic Outlook, March 2026.
And what's the core takeaway there?
The document explicitly states that this flash PMI will provide the first indications of the fallout on economic activity following these recent inflation shocks.
Let's dig into the mechanics of why the PMI matters so much more than the CPI right now.
Sure.
The Purchasing Managers Index surveys the actual people running the factory floors, the people ordering the raw materials.
Right. CPI tells you what happened to prices in the past, but the PMI tells you what is happening to corporate behavior right this second.
It is the difference between an autopsy and a live pulse.
Oh, that's exactly what it is.
Yeah.
In any period of economic shock like the sudden spike in upstream energy costs we saw in Thursday's BLS data.
Real human and corporate behavior turns long before the official hard data catches up.
Think about a mid-sized manufacturer of car parts. If that purchasing manager sees their input costs skyrocketing, but their clients are suddenly delaying orders, what do?
They panic and cancel their own raw material orders immediately.
Exactly. That behavioral shift happens weeks or months before that canceled order eventually drags down a quarterly GDP report.
So the PMI is basically the smoke detector.
It is. And if you pair that with the University of Michigan consumer sentiment data, which listeners can track at sca.asr.umich.edu,
You get a real-time read on both the corporate and the consumer psyche.
which brings us to your actionable intelligence for Tuesday, March 24th. When that S&P Global Flash PMI drops, do not just look at the headline composite number.
The headline is just noise.
Total noise. You have to dig into the subcomponents, look specifically at new orders and input prices.
Because if new orders are dropping, meaning economic demand is drying up, but the input prices component stays elevated.
You're looking at the literal definition of stagflation.
Shrinking growth, sticky costs.
Taking root right on the factory floor. A brutally toxic combination.
And the PMI will show you that reality weeks before a lagging CPI report confirms it for the broader market.
Absolutely.
Okay, so we have our eyes on the behavioral turn with the PMI. But let's go even deeper for segment 4.
Let's do it.
Let's look at the foundational bedrock beneath all of this data, U.S. Treasury funding.
Oh, the liquidity reality check.
Yes, because the prevailing narrative is that the government will always effortlessly fund itself.
Right. People just blindly assume the Treasury can borrow whatever it needs, whenever it needs it, without any market friction.
But if we want actual, observable, mechanical proof of market health, we have to look at the plumbing. We can't just listen to the pundits.
We have to look at the auctions. And It is a reality check the market prefers to ignore until it suddenly can't.
So where do we find this proof?
We don't look at speeches from policymakers. We look directly at the raw U.S. Treasury tentative auction schedule.
Which is published at home.treasury.gov system files 221 tentative auction schedule.pdf.
Next week is going to be a massive, unavoidable liquidity test for the entire financial system.
Let's lay out the gauntlet.
Okay, so on Tuesday, March 24th, the Treasury is auctioning the 2-year note.
Okay, 2-year on Tuesday.
On Wednesday, March 25th, they auction the 5-year note.
Got it.
And then on Thursday, March 26th, they hit the market with the 7-year note auction.
And all of these settle the following Tuesday.
That is hundreds of billions of dollars in sovereign debt that the market has to absorb in a 72-hour window.
It's exactly like an open house in real estate.
How so?
Well, the selling agent can talk up the property all week on CNBC, right?
Yeah.
Telling everyone how great the neighborhood is and how robust the demand is.
Sure.
But the auction is the moment of truth. It shows who actually shows up to the front door with a cleared check.
That's a great way to frame it.
And I know we'll be posting all of these specific auction schedules and real-time results over on X at Real Gilded News so everyone can follow along.
Definitely follow that.
But for the listener right now, when those results hit, how do we actually read these demand probes?
You need to check 3 specific metrics in the Treasury's release for each of those auctions.
Okay, that's the first one.
First is the bid-to-cover ratio. This is your baseline measure of total demand.
It's basically how many dollars were bid for every dollar the government was trying to sell.
Exactly. So if that ratio starts falling across the 2, 5, and 7-year notes, overall demand is structurally weakening.
Right. But the second metric is where it gets highly sensitive, isn't it? The indirect bidder share.
Yes, the indirects.
My understanding is that this category is a crucial proxy for foreign central banks and major international real money investors.
That's spot on.
They have traditionally been the price-insensitive buyers that keep the whole system running smoothly.
Right. So if we're watching the indirect bidder share, we're basically checking to see if foreign buyers are stepping back.
And if they do step back, the domestic primary dealers are mechanically forced to swallow that debt.
Which drains liquidity from the rest of the domestic market.
You have the mechanics perfectly. If the indirect bidders vanish, the domestic banks have to use their own balance sheets to absorb the supply,
Leaving less capital available for corporate lending or equity markets.
which leads us to the final and perhaps most critical metric of the auction, the tail.
The tail.
Let me make sure I have the sequence of the tail correct.
Go for it.
Before the actual auction takes place, the debt is trading in what's called the when-issued market.
Right.
It's essentially a forward market where dealers are guessing and pricing in the expected yield of the upcoming auction.
Yep.
So the tail is the difference between that expected yield and the actual yield the Treasury has to accept to clear the auction.
That is the exact mechanism. If the auction clears at a yield higher than what the when-issued market expected, it means the Treasury had to offer a sweeter deal,
A higher interest rate.
just to convince enough buyers to take down the debt. That difference is the tail.
So a widening tail means the government is actively sweating to find buyers. They're paying a premium just to get the debt off their books.
It is a glaring red flag. If the tail widens aggressively while the bid-to-cover ratio drops, you have undeniable mathematical proof that liquidity is tightening.
And it is tightening exactly where it matters most.
At the foundational bedrock of the global risk-free rate, you can't spin a bad Treasury auction. It is pure mechanical truth.
So let's pull all of this together. We've gone from looking backward at how the calendar was structurally weaponized to overwhelm us with narrative.
Looking forward at the tools we need to navigate next week.
Exactly. By looking at the literal schedules and the primary sources, from the BLS PPI releases to the S&P Global Flash PMIs all the way down to the U.S. Treasury auctions, you completely shift your posture in the market.
You really do.
You stop being a passive consumer reacting to chaotic headlines, and you become an active reader of the system's structural plumbing.
And that is the ultimate goal of this deep dive. But, if we accept that the calendar is indeed a control surface used to direct our attention.
Like shining a massive spotlight on certain data drops while burying others in the rush.
Exactly. Then the most important question for you to ask next week might not actually be what is on the schedule.
Wait, really? What is it then?
The most vital question is, what isn't on the schedule?
Oh, wow.
What anomalies, what quiet regulatory shifts, or what unannounced data drops are happening in the silent gaps between these major, heavily publicized Treasury auctions?
Because that is exactly where the smart money is looking while everyone else is distracted by the noise. That's the kind of systemic questioning that keeps you ahead of the curve. Follow Gilded News on X at Real Gilded News for daily clips and the stories behind the stories.